Hello, this is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, part of Redbud Realty and Associates. This is the third in a series about investment real estate and how to use certain terms to find out, is this investment meeting your needs? Is it going to give you the return that you want? Now, these are all done back to back. The first one I did on capitalization rate, which is where you take the total investment and you take the money that you get previous to debt service and you do a percentage, like a 9 cap or a 10 cap capitalization rate. The second one that I did, the last one I did, was on cash, a very good one, because what it does, it takes the amount of money that you get after everything is taken out, including debt service if you have it, and it says how much of my money am I getting back in that first year, percentage-wise. So as the example I gave, if we got 20% back of our real cash, it's a good opportunity that we could say, hey, we're going to, in 5 years, we're going to get all our money back from that investment, and yet we're going to hold it for 5 or 10 years more with positive cash flow. Now, the third one is more difficult, and it requires some, let's say predictions that go into it. The first two are like snapshots. We can pretty well say what's going to happen in the first year. But if we take internal rate of return, which is defined as what is your return on investment for the length of investment, as long as you keep all that money in the investment. What is going to be our percentage return? And the reason why we like this, even though again, like I say, we need to have a few things that we analyze that may be predictions, is that we want to look, let's say, over a 7-year period of time and say, you know, in the first 7 years of owning that property, I want to compare my percentage return to a mutual fund or a stock fund or whatever it happens to be that you're trying to compare it against to see if real estate is something that you want to put part of your investment money into. So here's the way it goes. We're going to do much of the same analysis as we do in capitalization rate and cash on cash. We're going to take the purchase price. We're going to take the debt service, your interest rate. We're going to talk about how much that's going to cost you over that 7 years. We're also going to take things like vacancy rate and like property management, everything that we do in those first two, except a couple of things are a little bit different over that 7-year period of time, one of which would be appreciation. Now, we know that we've been through a pretty tough period of real estate and that it is on its way back from the meltdown that started in 2007, and that Oklahoma City really didn't have that same kind of a meltdown, but real estate was affected. So it's very important that when you get this long-term rate of return, this 7-year period, that we stay pretty conservative about what we do in appreciation. So my suggestion is that if you want to look at a reasonable amount, would be 3% per year. And I say that because right now we're appreciating at a greater level than that, 5% and more in some cases because of the solidity of our market. But something, we don't really want to do that. We'd rather kind of give you a return that is reasonable, and we'd love to exceed it for you. So we want to put in about a 3% return. So all our investments are going to be better, of course, because when we sell it, if that's what we do at the end of 7 years, because of the appreciation, we're getting more cash back. That's a real bonus. Now, the other thing that is a prediction is the fact of what do you do if we're going to keep the money in the investment? There's a couple of things that we can do. We can take our profits, our positive cash flow, which to me is the only way to buy real estate, and we can reinvest it by, say, paying down the principal so that at the end of the 7 years that we owe less on it and therefore we get more cash back. The other idea is to not to do that because really how good as that might be for you really in that particular period of time. So let's say, for instance, you want to put it into some kind of very simple conservative fund. Maybe you put it in the bank, you get 2%, 2.5% on your money, and we're going to compute that in there because what we want to do is we want to take your cash and we want to make that work too. So not only are we making the investment work by lowering the principal every month and your renter is paying for that lowering of principal, but also that with the appreciation and also with the reinvestment in some way of something that's a guaranteed type return. So if you have a 4% interest rate on your mortgage, you're getting a 4% return. Essentially by paying that 4% interest mortgage down, or like a 2.5% that you get in some kind of a bank, simple bank fund. So what we're going to do is we're going to look at over the 7-year period, and we're going to give you 2 ways to look at this. We're going to give you one way is if I just cashed out and I paid a couple of different taxes that I have to pay, including capital gains and what's called recapture tax, then this is what I'm going to net out after tax, and we're going to give you that percentage. Let's say it's 17%. We're also going to give you one before tax because we want you to compare this against a mutual fund, and that may be 25% in terms of an annualized return on investment as long as that money stays in the investment. Those are the 3 things that we analyze when we look at these things. Now, that's not the only thing that we analyze, but I just kind of wanted to go through the metrics, through the money aspects of investing in real estate. There's a lot more to this. I'll be doing this again in other videos, even though I've done them over the past couple of years, just to kind of update you about things like property management, about how we select certain neighborhoods, and other aspects to try to ensure that you get the best deal for your money that over that 7-year period, you're going to be just very happy with. This is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.